Canadian investors love investing in real estate stocks to own some of the country's most prime real estate and to receive some nice dividends. But the longer you're in the real estate game, you notice a few things are happening all the time. Buying real estate investments at the wrong price or location in town can be devastating. And then there can be operational risks, like tenants not being able to make payments, property maintenance costs over time, or real estate projects just becoming too expensive or delayed. Not to say that owning real estate is bad or there's no money to be made, but some of the risks I've mentioned are probably why a lot of REITs on average this past decade have seen relatively stagnant stock price appreciation. In reality, if most REITs didn't provide their dividends, there'd be little to no investment gains, since it pretty much made up the bulk of their performance. Another thing I've noticed is that companies servicing the real estate industry tends to keep making more money every year, and they're less affected by the typical real estate risks. Service companies also have very little capital requirements for operations, since they don't need the money to buy properties or materials, and the revenues are highly predictable and recurring, since it's typically set in stone through long-term contracts. So as long as people have an increasing need for real estate or are investing in real estate, then there will always be a need for real estate services. I like to think of the real estate situation like that of the gold rush. Back in the day, everyone was on the rush to strike gold and hopefully become rich. But of course many tried and didn't strike gold, but those who did became rich. During that time, another group of people became very rich, but didn't do any gold mining. It was those who sold tools to the people rushing to strike gold. In many cases, the people who sold tools became richer than the people who actually struck gold. In our case, I think the people hoping to strike gold are those who are trying to buy the best real estate for a profit. The people who strike gold are the few who are actually successful in creating their real estate empire, and the people who sell the tools would be the real estate service companies. So here's two real estate service companies in Canada that are killing it as stock investments. The first is First Service. They're a Toronto-based real estate service company that provides property management services to residential and commercial customers in North America. This includes on-site staffing for building engineering and maintenance, full-service amenity management, security, front desk concierge, and financial services. If you're living in a Toronto condo that has on-site property managers or front desk, there's a chance that they're part of First Service. Regardless or not if the real estate market is doing well or tenants are not able to pay, First Service isn't really directly affected, and they're contracted for their ongoing job responsibilities to the building owners. So how well did they perform as a stock? In the last 12 months, including dividends, an investment would have rose by 35%. If invested over the last 5 years, the investment would have risen by 308%. That's an annualized growth of 32% per year. And if since inception, which is just a few months prior to that, the results would have more than doubled. A bit about their financial profile. First Service has a market capitalization of $7.6 billion. That's larger than the sum of Canada's biggest REITs. They have a 0.5% dividend yield, of which the dividend has historically been rising by roughly 11% per year. Revenues are $2.6 billion, and it's divided almost equally between management of residential communities and providing other essential property services like fire protection and property restoration. They do this through their subsidiary company brands. Geographically, the revenues are 90% US and 10% Canada. And in total, it's been growing by roughly 16% per year. From a profit perspective, they grew it by roughly 24% per year by also finding other ways to improve their costs and operations. So what's next for the company? They're growing through referrals of their existing client base, they're using their large scale of business and differentiated services to drive new clients, they're expanding the range of services, they're going to new geographies through acquisition of local companies, and they're expanding into property restoration and other related services like fire protection and renovations due to the increasing catastrophic weather events like hurricanes and fires and the increasing age of old buildings. The management team suggests that through their planned initiatives, they can grow their revenues by at least 10% per year. The second is Altus Group. They're a Toronto-based company that provides software, data solutions, and independent advisory services to the commercial real estate industry in Canada, US, Europe, and Asia Pacific. They're mostly known for providing data analytics, real estate valuation and tax services, and market research insights. For instance, here's a sample report that they issued talking about the various Toronto real estate markets like commercial, industrial, office, and residential, as well as some of the trends that they're seeing. I've included a link in the description below for their site to view their sample real estate reports. So how well did they perform as a stock? In the last 12 months with dividends, an investment would have rose by 43%. If invested over the last 5 years, it would have rose by 177%, which is an annualized growth of 23% per year. And if over the last decade, it would be 317%, which is 15% per year. A bit about their financial profile. Altus Group has a market capitalization of $2.2 billion. That's similar to the median size of Canada's biggest REITs. They have a 1.1% dividend yield, but the dollar amount of dividends hasn't changed over time. Revenues are $567 million and is divided between reporting segments like this, with Altus Analytics making the bulk of it. Geographically, the revenues are divided like this, with a majority from North America. In total, revenues have been growing by roughly 9% per year, although from a profit perspective, they grew at a slower rate of roughly 5% per year due to higher costs to scale the business to the next level. So what's next for Altus Group? They're creating cloud-based solutions to help the commercial real estate market get better data analytics and to provide further advisory services. They're acquiring smaller companies to expand their offerings and client reach, and they're working extensively with clients that are expanding geographically. From the analytics side of revenues, the management team suggests that from their initiatives, they're targeting revenue growth of 17% per year until 2023. So how do these two real estate companies compare to owning the Canadian REITs? From just a 1-year and 5-year perspective of investment gains, the two real estate servicers did very well on their own and against the Canadian REIT index. When placed against some of the best performing Canadian REITs like Granite, InterRent, Cap REIT, and Killam, it did very well, even over longer periods of time. But this might not be a fair comparison because of the bigger stock market losses this year experienced by many REITs. So assume that the ETF and best performing REITs had no losses this year from the pandemic and their investment performance were adjusted higher for it. The real estate service companies still outperformed. Even if you assume that no one in the real estate industry had gains this year, and the gainers were revised down for it, the real estate service companies were at least on par against the best performing Canadian REITs. When you think about it intuitively, the more the REITs grow over time through new property acquisitions, development projects, expansions, and tenants, then the real estate service companies will likely get new stable business contracts, be it through additional property or advisory services. So that's all for now. If you enjoyed this video or learned something new, remember to like and subscribe. Let me know in the comments below your thoughts on the real estate service companies and whether you think they're interesting stocks. And I'll see you next time.